Hey there, welcome back to the channel. Today, we're diving into the world of dividend stocks and ETFs, the real champions of passive income. If you're looking to make your money work for you, you're in the right place. Let's explore how these investments can help you build wealth and generate steady income. So, what exactly are dividend stocks? They're shares in companies that pay regular dividends to their shareholders. Think of it as getting paid just for owning a piece of the company. Some big names like Coca-Cola and Johnson & Johnson are known for their dividends. Now, how do these stocks work? When you invest, you buy shares of a company that shares its profits with you. If you own 100 shares and the dividend is $1, you get 100 every payout. Why should you consider dividend stocks? First, they provide steady income, especially when you reinvest over time. Second, they tend to come from established companies, reducing your risk. And third, reinvesting dividends can lead to compound growth over time. Now, let's talk about ETFs, or exchange-traded funds. These are investment funds that hold a collection of assets, like stocks or bonds. Dividend ETFs focus specifically on stocks that pay dividends, offering a diversified approach. Why choose dividend ETFs? They provide diversification, spreading your investment across many stocks. They also often have lower fees compared to mutual funds, which is a win. Plus, they offer regular income with the added benefit of diversification. How do they work? A dividend ETF holds a portfolio of dividend-paying stocks and distributes the dividends to you. This way, you can access a variety of high-quality stocks without picking them individually. When choosing the best dividend stocks or ETFs, look for a few key factors. Check the dividend yield, but don't choose based solely on that. Look for companies with a solid dividend history too. And if you're going for an ETF, keep an eye on the expense ratio. Lower fees mean better returns. Some top dividend stocks to consider are Coca-Cola, AT&T, and PepsiCo. For ETFs, check out Vanguard Dividend Appreciation ETF, iShares Select Dividend ETF, and Schwab US Dividend Equity ETF. In conclusion, dividend stocks and ETFs are fantastic for building passive income and growing your wealth. Whether you're a seasoned investor or just starting out, they're a great option for steady returns.
Hey everyone, welcome back to the channel. Today we're diving into cryptocurrency staking, a cool way to earn passive income with your crypto. Ever wondered how people make money from crypto beyond just buying and selling? Staking might just be the answer for you. Let's break down what staking is and how it works. Staking is all about holding a certain amount of crypto in a wallet to support a blockchain network. In return, you earn rewards, usually more cryptocurrency. Think of it like earning interest on a savings account, but with potentially higher returns. Staking is available with proof-of-stake cryptocurrencies like Ethereum 2.0, Cardano, and Solana. So how does staking work? First, you lock your crypto in a staking wallet. The more you stake, the better your chances of validating transactions. Validators are chosen randomly based on how much crypto they've staked. By staking, you help secure the blockchain and earn rewards in return. These rewards can come daily, weekly, or monthly, depending on the network. Why should you consider staking? First off, it's a way to earn passive income without much effort. Plus, you're supporting the network's security and stability. Staking can offer high returns, sometimes between 5% to 20% APY, and it's more energy efficient than traditional mining methods. Ready to start staking? First, pick a cryptocurrency that supports staking. Then, choose a staking platform. There are plenty out there. Transfer your crypto to the platform and start staking. But remember, there are risks involved too. If your validator misbehaves, you could lose part of your staked funds. Market volatility can affect the value of your staked coins, so be cautious. Some platforms have lock-in periods, so you can't access your funds right away. And always use trusted platforms to avoid hacks or issues. In conclusion, staking is a fantastic way to earn passive income while supporting blockchain security. Just make sure to do your research and understand the risks involved. Hey everyone, welcome back. Today, we're diving into two awesome ways to save and grow your money: high-yield savings accounts and certificates of deposit, or CDs. If you want to earn more interest than a regular savings account without much risk, these options are for you. Let's break down what they are and how they can help you grow your savings. First up, what's a high-yield savings account? It's a savings account that offers a much higher interest rate than traditional ones. This means your savings can grow faster, and you can access your money anytime. Now, how does it work? In a regular savings account, you might earn less than 1% interest. But with a high-yield account, you could earn 2% to 4% annually. You deposit your money, and the bank pays you interest, which is usually compounded. This means you earn interest on both your initial deposit and the interest that builds up over time. So, why choose a high-yield savings account? First, liquidity. Your money is easy to access without penalties. Second, low risk. These accounts are FDIC insured up to $250,000. And lastly, better returns than traditional savings accounts. Now let's talk about certificates of deposit, or CDs. A CD offers a fixed interest rate for a set period, like a few months to several years. You agree to leave your money in the account for that term, and in return, you get a higher interest rate. During the term, you can't withdraw without a penalty, but at the end, you get your deposit back plus interest. CDs usually offer higher rates because they lock your money in for a while. So, why choose a CD? First, higher interest rates than both high-yield savings accounts and regular savings accounts. Second, predictable returns. You know exactly how much interest you'll earn. And third, safety. Like high-yield accounts, CDs are FDIC insured. Now, let's compare high-yield savings accounts and CDs. High-yield accounts are more flexible. You can access your funds anytime. CDs have higher interest rates, especially for longer terms, but you can't access your money easily. If you need liquidity, go for a high-yield savings account. If you can lock away your money for better returns, a CD is a great choice. In conclusion, both options are safe ways to earn interest on your savings. If you want easy access, choose a high-yield savings account. But if you can afford to wait, a CD can offer higher returns. Whichever you choose, both are excellent tools for growing your savings. Welcome back to the channel. Today, we're diving into a hot topic. Should you invest in gold or Bitcoin? Both have their perks and pitfalls, so let's break it down together. Gold has been a trusted store of value for centuries. Before Bitcoin, gold was the go-to currency worldwide. Its value has stood the test of time, even in our digital age. Gold is often seen as a safe haven during economic uncertainty. When markets crash, people flock to gold for stability. It's tangible and doesn't rely on any central authority. Gold is easy to buy and sell, giving you quick access to cash. But remember, gold prices can fluctuate based on global demand and mining costs. Now, let's shift gears to Bitcoin, the digital gold. Bitcoin has exploded in popularity over the last decade. It's a decentralized cryptocurrency, not controlled by any government. Transactions are verified by a network, making it unique. Bitcoin has shown incredible growth, turning cents into thousands. Its fixed supply of 21 million adds to its allure. But be cautious. Bitcoin is highly volatile. It can swing dramatically, making it a risky investment. On the flip side, Bitcoin is accessible to anyone with an internet connection. Now, let's compare gold and Bitcoin on key factors. Gold is stable but offers limited growth potential. Bitcoin has high growth potential but comes with greater risk. Gold is a physical asset while Bitcoin is entirely digital. Gold has been a hedge against inflation for centuries. Bitcoin's performance during inflation is still being tested. Both are liquid, but Bitcoin is accessible 24/7 online. Gold is lower risk, while Bitcoin can be a wild ride. So which one is right for you? If you're conservative, gold might be your best bet. But if you're open to risk for potential high returns, consider Bitcoin. Some investors choose to hold both for balance. In conclusion, your choice depends on your goals and risk tolerance. Gold offers stability, while Bitcoin offers growth potential. Think carefully about your financial situation before deciding. If you found this video helpful, hit that subscribe button for more investment tips.
Want to build wealth without constantly watching the market? Dividend stocks might just be your answer. They're a powerful way to create long-term wealth, and I'm here to show you how. So, what exactly are dividend stocks? Simply put, they're shares of companies that pay regular dividends to their investors. Instead of selling for profit, you get cash payouts while holding on to your investment. These companies are often stable and established, making them great for passive income. But the real magic happens when you combine income with compounding growth. Why should you consider dividend stocks? First, they provide a steady income stream, perfect for retirees or anyone seeking passive income. You can reinvest those dividends or use them as extra cash. Second, reinvesting dividends allows for compounding growth. Over time, the more shares you own, the more dividends you earn, leading to exponential growth. Third, dividend-paying companies are usually more stable and less volatile. This stability can help cushion your portfolio during market downturns. Step 1. Choose the right dividend stocks. Not all dividend stocks are created equal, so pick wisely for long-term success. Look for a balanced dividend yield between 2% to 5% for income and stability. Next, check for companies with a history of increasing their dividends. These dividend aristocrats are generally safer bets for your portfolio. Also, consider the payout ratio. A low ratio means room for future growth. Step 2. Diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different sectors. This way, if one sector struggles, others can still perform well. For example, think about healthcare, utilities, consumer staples, and tech. Step 3. Reinvest your dividends. Using dividends to buy more shares is a powerful way to build wealth. Many brokerages offer automatic reinvestment programs, making it easy. The earlier you start, the more your wealth can grow over time. Step 4. Monitor your investments. You don't need to be glued to the screen, but keep an eye on your portfolio. Check key metrics like earnings growth and dividend stability. If a company's fundamentals start to slip, it might be time to reassess. Step 5. Be patient and think long-term. Dividend investing is a marathon, not a sprint. Don't expect quick returns. Stick to your strategy and let compounding do the heavy lifting. Understand the tax implications of your dividend income too. In many places, dividends are taxed at a lower rate than regular income. If you prefer a hands-off approach, consider dividend stock ETFs. These funds offer instant diversification and exposure to various sectors. Popular options include the Vanguard Dividend Appreciation ETF and iShares Select Dividend ETF. Building wealth with dividend stocks is a proven strategy for steady income and growth. Choose quality stocks, diversify, reinvest, and maintain a long-term mindset. Start today, stay patient, and watch your wealth grow over time. If you found this helpful, like, subscribe, and hit the bell for more tips on building wealth. Hey everyone, welcome back. Today, we're diving into how to create a balanced portfolio. Whether you're just starting out or looking to optimize, a balanced portfolio is essential. It helps manage risk while maximizing potential returns. So, what exactly is a balanced portfolio? It's all about diversifying your investments across different asset types. This way, you're not overly reliant on one asset class. Let's break down the 3 key asset classes you should know. First up, stocks. These are your high-risk, high-reward investments. Next, we have bonds, which offer more stability and steady income. And don't forget cash or cash equivalents for liquidity and low risk. Now, how do you balance your portfolio? Start by determining your risk tolerance. Are you young and willing to take risks? Or are you closer to retirement and prefer a conservative approach? Once you know your risk tolerance, it's time for asset allocation. A popular choice is a 60-40 split between stocks and bonds, but adjust these percentages based on your goals. Within each asset class, diversify even further. For example, mix large cap and small cap stocks, and with bonds, consider government and corporate options. Rebalancing is key. Check your portfolio regularly. If stocks are doing well, they might take up too much space. So, adjust back to your desired allocation. Let's say you're 35 with a moderate risk tolerance. A balanced portfolio could be 60% stocks, 30% bonds, and 10% cash. This mix balances growth, stability, and liquidity. Why is this important? It helps manage risk by spreading your investments around. Plus, it improves your chances of consistent returns over time. And ultimately, it supports long-term growth. Creating a balanced portfolio is a smart way to protect your wealth. So, evaluate your risk, diversify, and rebalance regularly. Are you ready to take control of your financial future? Diversifying your investment portfolio is the way to go. It's all about spreading your investments across different assets. Think stocks, bonds, real estate, and more to minimize risk. By diversifying, you protect yourself from losing it all if one investment falters. Risk management is a huge perk of diversification. Instead of putting all your eggs in one basket, spread them out. This way, a market crash won't wipe out your entire portfolio. In the stock market, diversify by investing in various sectors. Don't forget to include both domestic and international stocks for a broader reach. Bonds and fixed income investments add stability to your portfolio. They often perform well when stocks are down, balancing your risk. Real estate can be a fantastic diversifier too. Whether it's physical properties or REITs, real estate offers growth and income. Alternative investments like gold, oil, and crypto can provide unique opportunities. They may be riskier, but they can also lead to great returns. Understanding your risk tolerance is crucial before diversifying. Are you ready to take on more risk for higher returns? Or do you prefer stability? Your risk tolerance will shape how you allocate your assets. A balanced portfolio might look like 60% stocks, 30% bonds, and 10% alternatives. Mutual funds and ETFs simplify diversification by pooling investments together. This way, you can invest in a wide range of assets without the hassle. Remember to rebalance your portfolio over time to stay aligned with your goals. Market fluctuations can shift your allocations, so keep an eye on it. But be careful not to over-diversify. It can dilute your returns. Aim for a strategic mix that's easy to manage, not a cluttered mess. Diversification is a long-term strategy for steady growth and manageable risk. The goal is to build a portfolio that can weather downturns and still thrive. So, start small, stay consistent, and diversify wisely.
Welcome to 2025. Thinking about investing? You're in the right place. The financial world is changing fast, and starting today can set you up for success. But where do you begin? Let's dive into the steps you need to take. First, let's cover the basics of investing. It's about putting your money into assets with the hope of making a profit. But it's not just about money, it's about building wealth over time. In 2025, you have several investment options to consider. Stocks are popular. Buying stock means owning a piece of a company. If the company does well, you do too. But remember, stocks can be volatile. Bonds are loans to corporations or governments, paying you interest in return. They're generally less risky than stocks, but offer lower returns. Real estate can provide steady cash flow through rental properties. With platforms like REITs, even small investors can enter the market. Cryptocurrency is booming in 2025, but it's highly speculative. Only invest what you're willing to lose. Before you start, set clear goals. Why are you investing? Is it for retirement, a big purchase, or just to build wealth? Understanding your goals helps shape your investment strategy. If you're investing for retirement, focus on long-term, lower-risk options. Building a diversified portfolio is crucial. Diversification reduces risk. Spread your money across different assets to cushion against losses. Every investment comes with risk, so know your comfort level. Some prefer high-risk investments, while others want safer options. The more risk you take, the higher the potential return, but also the potential loss. In today's digital age, countless resources help you research investments. Websites and apps make it easier to analyze stocks, bonds, and more. Always do your homework before making any investment decision. To start investing, open an investment account, like a brokerage or IRA. Many platforms today offer low fees and easy access for beginners. One strategy is dollar-cost averaging. Invest a fixed amount regularly. This helps you avoid timing the market and reduces risk. Investing can be emotional, especially during market downturns. Stay focused on your long-term goals and avoid rash decisions. Patience is key. Building wealth takes time. Compounding interest and reinvestment can lead to significant growth. Starting your investment journey in 2025 might feel overwhelming, but you don't need to be an expert. Start small, diversify, and focus on long-term goals. With the right mindset, your investments can grow into something meaningful. If you're ready to start, take action today. The future of investing is bright, and it's yours for the taking. Thanks for watching. ESG investing is reshaping how we think about finance and the stock market. It's about choosing companies that prioritize environmental, social, and governance practices, not just profits. ESG stands for Environmental, Social, and Governance, aligning your investments with your values. Investing in ESG means supporting companies that care about their impact on the world. Environmental criteria. Ask how a company manages its ecological footprint. Do they minimize waste and use renewable energy? These questions help investors gauge a company's commitment to the planet. Social criteria focus on how companies treat their employees and communities. Are workers treated fairly? Is there a commitment to diversity? Governance looks at a company's leadership and transparency. Investors want to know about board diversity and ethical practices. ESG investing has surged in popularity, with assets expected to reach trillions. Investors see that companies with strong ESG practices can be more sustainable long-term. Investing in ESG companies creates a positive impact and often leads to better financial performance. These companies are better equipped to handle risks like regulatory changes and reputational issues. Getting started with ESG investing is simple with online platforms offering ESG-focused funds. You can also explore individual companies with strong ESG ratings. To evaluate companies, look at ESG ratings from agencies like MSCI and Sustainalytics. These ratings help you understand a company's environmental and social impact. Some think ESG investing means lower returns, but studies show otherwise. With more data available, making informed decisions is easier than ever. If picking stocks isn't your thing, consider ESG-focused funds or ETFs for diversified exposure. ESG investing encourages companies to be more responsible and accountable. The demand for ESG products is pushing businesses to improve their practices. As interest in ESG grows, expect more innovation in sustainable technologies and practices. The future of investing is green, responsible, and socially conscious. By integrating ESG factors into your strategy, you're not just making money, you're making a difference. Start your ESG investment journey today and help create a better tomorrow. Hey everyone, welcome back to the channel. Today, we're diving into something super exciting: peer-to-peer lending, or P2P lending. This innovative way to invest and borrow money connects you directly with lenders online, skipping the banks. If you're looking for a fresh alternative to traditional loans or investments, P2P lending might be just what you need. So, what exactly is P2P lending? It's a method that lets borrowers and lenders connect directly, without the middleman of a bank. Borrowers can often snag lower interest rates, while lenders earn interest on their investments. It's a win-win for everyone involved. Here's how it works. Borrowers submit their loan applications on P2P platforms. They share their financial details and what they need the loan for. Then, lenders review these requests and decide how much to invest. They can fund part of a loan or go all in. Once funded, borrowers repay the loan in monthly installments, including interest. Lenders get their share back, plus earnings from interest. So, why should you consider P2P lending? For borrowers, it often means lower interest rates and faster approvals than banks. Plus, you get flexible loan terms that fit your needs. For lenders, it's a chance for higher returns compared to traditional savings. You can also diversify your investments by funding different types of loans. P2P lending gives you control over where your money goes. But let's talk benefits. It's accessible for those who might struggle with traditional loans. Investors can diversify their portfolios with various loan types and risk levels. And there's transparency. Platforms provide detailed borrower info to help you make informed choices. Of course, there are risks involved, like the chance of borrowers defaulting on loans. Liquidity can be an issue too. These loans aren't easy to sell if you need quick cash. And remember, the platform itself could face challenges, so choose wisely. Ready to get started? First, pick a P2P platform that suits your needs. Research interest rates, loan types, and fees before diving in. Next, assess your risk tolerance and start small if you're new to this. Monitor your investments regularly to keep track of how they're performing. Some top platforms to consider are Lending Club, Prosper, and Funding Circle. In conclusion, P2P lending can be a fantastic way to borrow or lend money. With potentially higher returns and lower rates, it's worth exploring. Just remember to do your homework and understand the risks involved.
I'm about to share some real estate investment tips that could change your financial future. Tip number 1. Start with your goals. What do you want to achieve? Are you after steady cash flow or quick profits? Your goals will shape your investment strategy. Tip number 2. Do your research. Understand the market and the property before you buy. Is the area growing? What's the rental demand like? Tip number 3. Build a network of professionals. Surround yourself with trusted experts. A great real estate agent can make all the difference. Tip number 4. Understand your financing options. Choose what aligns with your goals. Conventional loans or hard money loans. Weigh the pros and cons. Tip number 5. Location is key. Research areas with growth potential. An up-and-coming neighborhood could be your gold mine. Tip number 6. Consider property management. Do you want to manage it yourself or hire pros? Managing tenants can be overwhelming, especially with multiple properties. Tip number 7. Be ready for repairs and maintenance. Always budget for unexpected costs. Set aside a portion of your rental income for repairs. Tip number 8. Diversify your portfolio. Don't put all your eggs in one basket. Invest in different property types or locations to spread risk. Tip number 9. Be patient and think long-term. Real estate is a marathon, not a sprint. Focus on the long-term potential of your investments. Tip number 10. Continuously educate yourself. Stay informed about market trends and strategies. The more you know, the better decisions you'll make. Real estate investment can build wealth, but it takes strategy and planning. Follow these tips, and you'll be on your way to financial success.
Hey everyone, welcome back. Today we're diving into real estate investment trusts, or REITs. They're one of the best ways to invest in real estate without the hassle of managing properties. Whether you're new to investing or looking to diversify, REITs are a great option. So, what exactly is a REIT? A REIT is a company that owns or finances income-producing real estate. They pool money from investors to buy properties like office buildings and shopping malls. By investing in a REIT, you get exposure to real estate without the headaches of ownership. REITs are required to distribute at least 90% of their taxable income as dividends. This makes them popular for income-seeking investors. How do REITs work? They collect funds from investors to acquire properties, then rent or sell them for income. This income is distributed to investors as dividends. Most REITs are publicly traded, making it easy to buy and sell shares. Now, why should you consider investing in REITs? First, they offer diversification, reducing overall risk in your portfolio. Second, they provide regular income through attractive dividend yields. Third, REITs are liquid, allowing you to buy and sell shares anytime. And lastly, they give you exposure to various real estate sectors without the management hassle. There are three main types of REITs. Equity REITs invest directly in properties and earn income from rent. Mortgage REITs invest in real estate loans and earn interest. Hybrid REITs combine both equity and mortgage investments. Investing in REITs is simple. You can buy publicly traded REITs through a brokerage account, or consider REIT ETFs for diversification across different sectors. Private or non-traded REITs are also options, but they come with higher fees. The benefits of investing in REITs are clear. They provide steady income, diversification, and tax advantages. Plus, you don't need a lot of capital to get started. But remember, there are risks involved too. Market volatility can affect REIT prices, just like any stock. They're also sensitive to interest rate changes, which can impact profitability. And the success of a REIT depends on its management team's decisions. In conclusion, REITs are a fantastic way to invest in real estate without the hassle. They offer great benefits, but it's crucial to understand the risks before diving in.
Hey everyone, welcome back. Today, we're diving into one of the hottest investment options for real estate lovers: REITs. If you've ever wanted to invest in real estate without the hassle of buying property, REITs are your answer. Let's break down what they are and why they could be a great addition to your portfolio. So, what exactly are REITs? A real estate investment trust is a company that owns or finances income-producing real estate. Instead of buying properties, you invest in shares of the REIT. This way, you can pool your money with others to invest in a diverse portfolio of real estate assets. How do REITs work? They collect money from investors to buy and manage properties like apartments, offices, and shopping centers. REITs generate revenue from renting or selling these properties and share a big chunk of that income with you as dividends. Why should you consider investing in REITs? First, they offer diversification, reducing risk while increasing potential returns. Second, they're liquid, easy to buy and sell on stock exchanges. Third, they provide regular income since they must distribute at least 90% of their taxable income as dividends. And lastly, you get access to professional management without the headaches of property upkeep. Now, let's talk about the types of REITs you can invest in. There are equity REITs, which own and manage properties, and mortgage REITs, which lend money to property owners. Then there are hybrid REITs that combine both strategies for a balanced approach. Investing in REITs has its perks, like steady income from dividends and lower entry costs compared to buying property directly. Plus, they can act as a hedge against inflation, since property values tend to rise over time. Getting started with REITs is simple. Just buy shares through a brokerage account like you would with stocks. If you want a hands-off approach, consider mutual funds or ETFs focused on REITs for broader exposure. But remember, there are risks to consider, like market volatility and interest rate sensitivity. If the real estate market dips, the value of the REIT can drop too, affecting your investment. Some top reads to check out include Vanguard Real Estate ETF, Realty Income, and Simon Property Group. In conclusion, REITs are a fantastic way to invest in real estate without the hassle of managing properties. Whether you're after diversification, regular income, or just want to dip your toes into real estate, REITs can be a valuable addition to your portfolio. Just make sure to do your research and understand the risks before jumping in. Welcome. If you've ever been curious about the stock market or thought about investing but felt lost, you're in the right place. In this video, we'll simplify the stock market basics so you can confidently start your investing journey in 2025. So, what is the stock market? It's a marketplace where you buy and sell shares or stocks of publicly traded companies. When you buy a stock, you're getting a tiny piece of ownership in that company. More shares mean a bigger stake. Why do companies issue stocks? To raise capital. They sell shares to fund growth instead of taking on debt. In return, stockholders can profit from the company's success. Investors can make money from stocks in two main ways: capital appreciation and dividends. Capital appreciation happens when your stock's value increases over time, like buying at $10 and selling at $15. Dividends are payments some companies give to shareholders from their profits, often quarterly or annually. Now, let's talk about different types of stocks you might encounter. Common stocks are the most typical. They give you voting rights, but are last in line if a company goes bankrupt. Preferred stocks offer priority for dividends and assets, but don't come with voting rights, often seen as more stable. To track the stock market's performance, investors look at indexes, which are collections of stocks representing the market or sectors. The S&P 500 tracks 500 of the largest U.S. companies, while the Dow Jones focuses on 30 major companies. The Nasdaq is tech-heavy, featuring many growth companies. Stock prices fluctuate based on supply and demand. More buyers mean higher prices, and more sellers mean lower prices. But prices also depend on a company's performance, industry trends, and the economy. With potential rewards come risks. Stock investing can be volatile, and prices can drop, leading to losses. That's why understanding risks and having a strategy is crucial. A key strategy to reduce risk is diversification, spreading your investments across different stocks and asset classes. This way, if one stock struggles, others might do well and balance things out. Getting started with stock investing in 2025 is easier than ever. First, choose a brokerage account to buy and sell stocks. Many platforms offer zero commission trading. Next, fund your account by transferring money from your bank or using services like PayPal. Before buying, research potential stocks. Look for companies you believe in with solid fundamentals. Start small and build over time. Consider dollar cost averaging to invest regularly, regardless of market conditions. There are several strategies for investing in stocks. Buy and hold for long-term growth, growth investing for rapid expansion, or value investing for undervalued stocks. The stock market can feel overwhelming, but once you grasp the basics, it's an exciting way to build wealth. Start slow, do your research, and invest with a long-term perspective. The earlier you start, the better your chances of growing your money. Welcome back to the channel. Today, we're diving into one of the most popular investment options: index funds. Whether you're new to investing or a seasoned pro, understanding index funds is key to building a successful portfolio. Let's break it down. First off, what are index funds? An index fund is a type of mutual fund or ETF designed to replicate the performance of a specific market index, like the S&P 500. Instead of trying to beat the market, index funds aim to match its performance. They follow a passive investment strategy, holding the same stocks in the same proportion as the index. One of the best parts? They have low management fees compared to actively managed funds. Now, let's talk about the benefits of investing in index funds. First up, low costs. With no expensive fund managers, you keep more of your money invested and growing over time. Next, instant diversification. An S&P 500 index fund includes the 500 largest U.S. companies across various industries, reducing risk. Over the long term, index funds have historically provided solid returns. They're simple to understand, no need to pick individual stocks. Plus, they're highly transparent, so you can see exactly what you're investing in. But let's not forget the downsides. Index funds can't outperform the market, since they just mirror it. You also lack flexibility. You can't adjust individual stock allocations. And while diversification is great, it means you might hold underperforming stocks. Many index funds are weighted by market cap, which can lead to overexposure to large companies. You don't have control over individual holdings either. In strong bull markets, index funds might miss out on big gains from top performers. So, when are index funds right for you? They're perfect for long-term investors who value stability and simplicity. If you prefer a low-effort investment strategy, index funds are a great choice. And for beginners, they're an ideal starting point for your investment journey. Welcome to 25. If you're looking to invest but don't know where to start, you're in the right place. Today we're diving into the top 5 investment strategies for this year. Whether you're a newbie or a seasoned pro, these tips can help you grow your wealth. First up is dollar cost averaging, or DCA. This strategy is all about consistency and reducing market timing risks. Instead of investing a lump sum, you invest a fixed amount regularly, like monthly. This way, you buy more shares when prices are low and fewer when they're high. Next, let's talk about index fund investing. Index funds let you build a diversified portfolio without picking individual stocks. They track a market index like the S&P 500, giving you broad exposure. Index funds are low cost and perfect for long-term growth without the hassle. Now, let's dive into dividend growth investing. This strategy focuses on companies that consistently increase their dividends over time. You'll build a portfolio that generates a growing stream of income year after year. Why is this great in 2025? Companies that pay dividends are often financially stable and well-established. Reinvesting those dividends can lead to exponential growth in your portfolio. Strategy number 4 is ESG. Sustainable investing. In 2025, ethical investments are in high demand. ESG stands for environmental, social, and governance, focusing on sustainability. If you care about making a positive impact, this strategy is for you. Last but not least, let's talk about cryptocurrency and blockchain investment. Crypto is now a mainstream asset class, and it's gaining traction. Investing in digital currencies like Bitcoin and Ethereum can diversify your portfolio. But remember, it's volatile, so only invest what you can afford to lose. Wondering how to implement these strategies? Start with dollar cost averaging by setting up automatic contributions. Choose low-cost index funds or ETFs to build a diversified portfolio easily. Research dividend stocks with a strong history of increasing dividends. Explore ESG funds that align with your values for sustainable investing. And if you're curious about crypto, start with established coins and reputable platforms. In 2025, investing is more accessible than ever. The strategies we discussed, DCA, index funds, dividend growth, ESG, and crypto, are powerful tools. The key to success: consistency, research, and a long-term mindset. Investing is a journey, so start with 1 or 2 strategies and watch your portfolio grow. Stay focused, stay informed, and let your money work for you. Thanks for watching. Hey everyone, welcome back. Today, we're diving into a crucial concept in investing: risk versus reward. Understanding how to balance these two is key to smart investment decisions. Let's break down what risk and reward mean in investing. Risk is the possibility of losing some or all of your investment. It's the uncertainty of how your investments will perform in the future. Every investment carries risk, but it varies by asset type and market conditions. Market risk, credit risk, interest rate risk, and liquidity risk are common types. Now, what about reward? Reward is the potential profit you can earn from an investment. Higher risk investments often offer higher rewards, while lower risk ones provide modest returns. Rewards can come as capital gains, dividends, or interest payments. The relationship between risk and reward is crucial for a balanced strategy. High-risk investments like tech stocks can yield significant gains, but also losses. Low-risk investments like bonds offer stability and steady returns. To assess risk versus reward, start by understanding your investment goals. Define what you're saving for and your time horizon. Evaluate your risk tolerance based on your comfort level and financial situation. Consider diversification to manage risk effectively. Analyze potential returns relative to the risks involved. Asset allocation affects your portfolio's risk and reward balance. Rebalancing keeps your investments aligned with your goals over time. Use risk management strategies like stop-loss orders or hedging. For example, a young investor might go for growth stocks despite market volatility. A conservative investor might prefer government bonds for stability. Real estate can offer high rewards, but comes with its own risks. In investing, understanding risk and reward is essential. By assessing your goals and options, you can build a portfolio that fits your needs. Are you curious about the stock market, but don't know where to begin? You're in the right place. Let's start with the basics. What is the stock market? It's a marketplace where investors buy and sell shares of companies. When you buy a stock, you're purchasing a small piece of ownership in a company. If the company does well, so does your investment. Companies issue stocks to raise money for growth, new products, or paying off debts. Your investment helps them expand. The stock market operates through exchanges like the New York Stock Exchange and NASDAQ, where stocks are bought and sold. There are two main types of stocks: common stocks, which give you voting rights, and preferred stocks, which offer dividends first. Stock prices fluctuate based on supply and demand. If more people want to buy a stock, the price goes up. To buy stocks, you need a brokerage account, which lets you trade stocks online through platforms like Robinhood or E-Trade. Many investors follow stock market indices, which are collections of stocks that represent a segment of the market, like the S&P 500. Diversification is key. Spread your investments across different sectors to reduce risk and protect your portfolio. Investing in stocks comes with risks, but historically, they offer higher returns than bonds or savings accounts over time. Let's cover some essential stock market terms. Bulls believe the market will rise, while bears think it will fall. Dividends are payments to shareholders from company profits, and an IPO is when a company first sells its stock to the public. The stock market may seem complex, but understanding these fundamentals can help you invest with confidence. Start small, learn as you go, and remember that patience is key in the long-term game of investing. Thanks for watching. Don't forget to like, comment, and subscribe for more tips on navigating the stock market. Happy investing! Artificial intelligence and frontier technologies are reshaping our world in ways we never imagined. By 2025, these innovations will revolutionize industries and redefine how we live and work. Let's explore how AI and frontier technologies will impact our future and the incredible opportunities they offer. Artificial intelligence, or AI, simulates human intelligence through machines. It includes technologies like machine learning, natural language processing, and robotics. AI is transforming our interactions, from self-driving cars to virtual assistants. By 2025, AI will be even more integrated into our daily lives, automating tasks and personalizing services. In healthcare, AI is revolutionizing diagnostics and drug discovery. AI tools analyze medical images and detect health risks faster than humans can. It's also predicting patient outcomes and streamlining administrative tasks. By 2025, AI will drastically improve healthcare efficiency and accuracy worldwide. In business, AI drives automation and enhances decision-making processes. AI tools optimize operations, from supply chain management to customer service. Chatbots powered by AI provide 24/7 support and personalized recommendations. By 2025, AI will be essential for businesses to stay competitive in a fast-evolving market. Quantum computing is another frontier technology making waves in 2025. Unlike classical computers, quantum computers process information at incredible speeds. This technology can revolutionize industries like finance and drug development. As quantum computing matures, it will unlock new opportunities across various sectors. AI and robotics are converging, creating smarter machines that enhance productivity. Robots are becoming more autonomous, performing tasks in manufacturing and healthcare. By 2025, robots will be integral to both industrial and consumer sectors. AI is also transforming education, making learning more accessible and tailored. AI analyzes student performance to adjust learning materials to fit individual needs. By 2025, AI will play a central role in making education more inclusive and impactful. While AI brings immense potential, it also presents ethical challenges. Issues like job displacement and privacy concerns must be addressed responsibly. By 2025, we'll see a global effort to tackle these challenges together. In conclusion, frontier technologies are set to transform our lives by 2020. The opportunities are limitless, but we must remain mindful of the ethical challenges ahead.
As we face an unprecedented climate crisis, clean energy is more important than ever. In 2025, we're witnessing a evaluating stocks is a 2025.
In the world of investing, international equities and emerging markets,
Welcome to your market.
private equity and alternative.
Balancing risk and return.
Have you ever thought about how finding the best investment? Market volatility is saving for college can feel overwhelming. Want to earn money while you sleep? Artificial intelligence.
Investment scams are on the rise.
Asset allocation is a... Hey everyone, welcome back. Hey everyone, welcome.
Hey everyone, welcome.
Welcome to our guide on the best.
Hey everyone, welcome back. Hey everyone, welcome back. Hey everyone, welcome back.
The world of finances. Hey there, welcome back to the channel. Today, we're diving into the world of dividend stocks and ETFs, the real champions of passive income. If you're looking to make your money work for you, you're in the right place. Let's explore how these investments can help you build wealth and generate steady income. So, what exactly are dividend stocks? They're shares in companies that pay regular dividends to their shareholders. Think of it as getting paid just for owning a piece of the company. Some big names like Coca-Cola and Johnson & Johnson are known for their dividends. Now, how do these stocks work? When you invest, you buy shares of a company that shares its profits with you. If you own 100 shares and the dividend is $1, you get 100 every payout. Why should you consider dividend stocks? First, they provide steady income, especially when you reinvest over time. Second, they tend to come from established companies, reducing your risk. And third, reinvesting dividends can lead to compound growth over time. Now, let's talk about ETFs, or exchange-traded funds. These are investment funds that hold a collection of assets, like stocks or bonds. Dividend ETFs focus specifically on stocks that pay dividends, offering a diversified approach. Why choose dividend ETFs? They provide diversification, spreading your investment across many stocks. They also often have lower fees compared to mutual funds, which is a win. Plus, they offer regular income with the added benefit of diversification. How do they work? A dividend ETF holds a portfolio of dividend-paying stocks and distributes the dividends to you. This way, you can access a variety of high-quality stocks without picking them individually. When choosing the best dividend stocks or ETFs, look for a few key factors. Check the dividend yield, but don't choose based solely on that. Look for companies with a solid dividend history too. And if you're going for an ETF, keep an eye on the expense ratio. Lower fees mean better returns. Some top dividend stocks to consider are Coca-Cola, AT&T, and PepsiCo. For ETFs, check out Vanguard Dividend Appreciation ETF, iShares Select Dividend ETF, and Schwab US Dividend Equity ETF. In conclusion, dividend stocks and ETFs are fantastic for building passive income and growing your wealth. Whether you're a seasoned investor or just starting out, they're a great option for steady returns.
Hey everyone, welcome back to the channel. Today we're diving into cryptocurrency staking, a cool way to earn passive income with your crypto. Ever wondered how people make money from crypto beyond just buying and selling? Staking might just be the answer for you. Let's break down what staking is and how it works. Staking is all about holding a certain amount of crypto in a wallet to support a blockchain network. In return, you earn rewards, usually more cryptocurrency. Think of it like earning interest on a savings account, but with potentially higher returns. Staking is available with proof-of-stake cryptocurrencies like Ethereum 2.0, Cardano, and Solana. So how does staking work? First, you lock your crypto in a staking wallet. The more you stake, the better your chances of validating transactions. Validators are chosen randomly based on how much crypto they've staked. By staking, you help secure the blockchain and earn rewards in return. These rewards can come daily, weekly, or monthly, depending on the network. Why should you consider staking? First off, it's a way to earn passive income without much effort. Plus, you're supporting the network's security and stability. Staking can offer high returns, sometimes between 5% to 20% APY, and it's more energy efficient than traditional mining methods. Ready to start staking? First, pick a cryptocurrency that supports staking. Then, choose a staking platform. There are plenty out there. Transfer your crypto to the platform and start staking. But remember, there are risks involved too. If your validator misbehaves, you could lose part of your staked funds. Market volatility can affect the value of your staked coins, so be cautious. Some platforms have lock-in periods, so you can't access your funds right away. And always use trusted platforms to avoid hacks or issues. In conclusion, staking is a fantastic way to earn passive income while supporting blockchain security. Just make sure to do your research and understand the risks involved. Hey everyone, welcome back. Today, we're diving into two awesome ways to save and grow your money: high-yield savings accounts and certificates of deposit, or CDs. If you want to earn more interest than a regular savings account without much risk, these options are for you. Let's break down what they are and how they can help you grow your savings. First up, what's a high-yield savings account? It's a savings account that offers a much higher interest rate than traditional ones. This means your savings can grow faster, and you can access your money anytime. Now, how does it work? In a regular savings account, you might earn less than 1% interest. But with a high-yield account, you could earn 2% to 4% annually. You deposit your money, and the bank pays you interest, which is usually compounded. This means you earn interest on both your initial deposit and the interest that builds up over time. So, why choose a high-yield savings account? First, liquidity. Your money is easy to access without penalties. Second, low risk. These accounts are FDIC insured up to $250,000. And lastly, better returns than traditional savings accounts. Now let's talk about certificates of deposit, or CDs. A CD offers a fixed interest rate for a set period, like a few months to several years. You agree to leave your money in the account for that term, and in return, you get a higher interest rate. During the term, you can't withdraw without a penalty, but at the end, you get your deposit back plus interest. CDs usually offer higher rates because they lock your money in for a while. So, why choose a CD? First, higher interest rates than both high-yield savings accounts and regular savings accounts. Second, predictable returns. You know exactly how much interest you'll earn. And third, safety. Like